and we definitely have a few things to talk about, especially coming up. The CPI coming up, we start, okay? So thanks everyone to be here with me. Today is Tuesday, so we're going to be talking about the weekly Forex outlook. Okay, so we're going to be having a look into gold, into euro dollar, into the Aussie against the US, into the pound against the US, and how we can trade them, okay? Especially today, because today is one of the most important, the second most important day of the week, because the first one will be on Thursday when we get the PPI. If I'm not wrong, is on Thursday or Friday? No, I think it's on Thursday. Anyways, so we got a lot of data coming this week, especially on the CPI matter, but today is one of the second most important because it's from USA, okay? And that being said, we have a lot of talks about sticky inflation. You know, will US CPI remain elevated? Will US CPI come down? Because at the moment, we're going to have a look into the data very soon. It has been very, very sticky the last couple months. Okay, a lot of comments from Jerome Powell, from Trump, and then from a few other members of the FMC. So lots of things happening. CPI. What's the CPI role in shaping the next Fed's move? Okay, because as always, Fed likes to see two main data, okay, and this is the PPI and the CPI. Both of them is the two main data that they like to watch, okay. Are they most important ones? Definitely not, because it's always a combination of factors and not only one factor. So we can't attribute to one thing or another thing. We need to look at the macro, the bigger picture, okay? But CPI has definitely a big role into the Fed next move. Then I'm gonna share with you guys my trading setups for the CPI tonight, at least tonight in Australia, but most likely in the morning, sort of afternoon-ish for Europe and US, okay? So I do have a few trades in mind into gold, euro dollar, Aussie against the US dollar, the pound dollar. So I'm gonna share them with you guys. Cool. As usual, before we go any further, I need to leave the risk disclaimer up for a few seconds, minutes. But before, let me just double check if there is anyone new here, because we got quite a few people here. Let me just have a look into it. Most I've not seen Ting's iPhone here before, so Ting's welcome. Hopefully you can have a good time with us. If you have any questions, please put down your questions. Also, Jay Guile, I've never seen that name here as well, so that's good. Hopefully you guys enjoy, and if you guys have any questions, please just send it over those questions into the chat. If you are a bit shy and you want to sort of send a private question to me, that's fine. I'm not going to read your name as well. Okay, cool. That being said, let me put the risk disclaimer up, and I'll be back in a minute or two and we can actually start the webinar. So let's first understand the CPI, okay? I'm guessing a lot of you here, comes to the webinar every Tuesday, Wednesday, and Thursday. So that's pretty good. And you sort of already understand how I trade and how I look at the market. For those who are here the first time, or for those who don't understand much about fundamentals and macro, let me tell you something. The Forex market has to move with something, and it's not going to be any technical analysis in a sense, okay? And the reason why this is true, and simple to prove why it's true, it's because we trade in currencies, okay? So Forex basically is currencies. Foreign exchange means something out of your country, okay? An exchange means exchanging whatever currency, exchanging instrument, everything. You can exchange anything with your friends. So basically, foreign exchange comes from countries. So if countries have access to currencies, whatever they do will interfere the currency price. Sometimes a country is more stronger than other, so therefore the currency of them will be stronger than others because most likely they have a better inflation rate, they have a better labor market, they have a better GDP, they have a better PMI, they have a low, in a sense, low inflation and a better inflation for low inflation. They have higher BOP, so balance of payments, so they exchange more with other countries and then making other countries buying from him. That is basically, if I want to buy something from you guys, I would, in a sense, as a country, I would have to use your currency to buy your product. So I would have to buy your currency and then put that currency into your pocket so I can have the product. So basically making trades with between countries that strengthen the currency. So whoever got more trades into the country makes the country stronger in a sense. Okay. Cool. That being said, now if we think about inflation, inflation is basically an economic data where we can see how the prices are changing for the consumer, the end consumer. Okay. We have the consumer price index and the producer price index. So we have the CPI and the PPI. The CPI will change after the PPI. Okay. Why? Because your goods that you have on your home will get affected before it gets placed into your hands. Okay. Let me exemplify that. So let's say you have an iPhone. Okay. Or not an iPhone, anything electronically, like a computer, a TV, phone, anything that is an iPad, whatever, tablet, whatever you got that is electronically. It has a lot of components on that. And if one component becomes more expensive than it were last year, most likely that price will reflect that component price up. Okay. So the CPI gets affected afterwards because the PPI, the producer, actually have to buy the goods first, and then he buys the goods with inflation already, and therefore he implements that into the mobile, and then he has the CPI. Okay, so hopefully I've made that clear. Is it resonate for you guys? I hope it helps to understand a little bit more. Now, the CPI is basically a basket of goods. It's not only one form, or it's not only electricals, let's say. It's a basket of goods, okay? So you have CPI basket, and you can see here, it's basically, that's from RBA. It's a pretty good image. I've used that into my blog one day. Let me open that. So the groups on the CPI basket are these ones, okay? It's not included for these ones. It can sort of get wider and wider, but into those groups, you have sections and then you have much more categories, right? So 87 categories divided into 11 groups, okay? So if my maths are not wrong, we have around seven items for each group. Okay, so alcohol and tobacco, clothing and footwear, communication, education, food and non-alcoholic beverage, furnishing, household equipment and services, health, housing, insurance and financial services, recreation and culture, and transport. This is basically the CPI. Okay, this is the consumer goods. The consumer price index. That is the consumer goods and services. Now, this all takes in measure, and it's not only one thing. Okay, so just you guys understand that, and why that is so important. Can anybody tell me why? Let's see if you guys are paying attention. Why the CPI is so important? It's a pretty simple question. Stuart say economy. Yes, that's a fair answer, but not quite there. So the CPI is important because we use that every single day. Okay. So we use that every single day. You have to buy clothes and you have to buy footwear. You have, maybe you don't, but maybe your son has to go, or that's it. Shaq said exactly it. So it what consumer rely on. That's exactly it. So that's why the CPI is important, because it's what the consumers, the everyday people use, and if there is a change into the prices, the CPI will show that with the inflationary. And therefore, what we're going to get is higher prices. Sometimes are lower prices, deflationary, okay? But as I was saying, most likely you have to buy clothes every few months. Most likely you have to pay for transport. It's been, public transport, whatever. Here in Sydney, we've paid $50 or $60 a week, and that's the cap. So you can travel a fair bit here, but after $50, you don't get charged anymore. Okay, so you have like the Opal card that we say. Not in Sydney, New South Wales in a sense. You have to go for health, right? You have to pay your rent, and rent is a big thing. You have to buy furnishings for that rent. You have to buy a food to eat and don't die. So there's a lot of things here, okay? And all of those things and all of those categories are basically consumers relying on, okay? Electricity, yes, electricity is one. Food and energy prices, they are into one of the most volatile items of the CPI basket, okay? And that's why we have the core CPI. The nominal CPI is with literally every single category and groups. The core CPI is without electricity and food prices. So basically, food and energy prices are excluded into the core CPI. The reason is because these two items, food and energy, they are the two most volatile items of the basket. So the central bank can't, in a sense, control that with the rates and all of the tools that they got. Okay, so that's it. So we're going off topic, but CPI, that's it. Okay, so do you guys have any questions about CPI? I think a lot of you actually that follow me quite for a while didn't quite get it. I think the only one that got it right was Shaq. So congratulations to Shaq. But congratulations for everyone that actually tried and send the message into the chat. Very brave. Cool. All right. So what are the expectations of the CPI for today? Okay, so let's have a look. For that, I'm going to be using the Finlogic's economic calendar. So very simple for you to get access. It's just type finlogics.com, or easier than that is click into the link that I've sent on the chat. Yes, I had plenty of videos on that chat. Congratulations on watching those ones. See, that's what I mean. If you're watching, you know. Come into tools, go into economic calendar. With that, you can come into recent and next, and then you can select only United States, stated, and put into high. Okay, and most likely that's what you're gonna get for now. Cool. Now let's have a look into the forecast. That is basically the expectations of the release and the previews. Okay. So for the month, we got 0.3%. Okay, so the first one here, we got 0.3% forecast from the previous 0.1. So we are already expecting a 0.2% higher than the previous. Okay, so that's already saying to me that the inflation is expected to come higher than before. So that shows to us that the last month had quite a good inflation rate. And now not the last month, sorry, the month before that, because the release is for the month of June, that is the last month. So if we had the inflation at 0.1 and now the economists are expecting inflation to be 0.2% higher than previously, so at 0.3%, it shows to me that it's very sticky, okay, and it's not going away at any cost. Then we go to the core inflation. Remember, the core inflation without food and energy prices. So it's a basket, but without food and energy prices. So that being said, the food and energy prices, they tend to be less volatile. Okay, they tend to be less volatile because not them. Okay, so the core CPI tend to be less volatile because it's without the food and energy prices. That is one of the most volatile items into the nominal inflation rate, okay, into the nominal CPI. So without those items, it should be less than 0.3, right? But in a sense, continues to forecast 0.3. So it's just showing to us how realistic sticky this inflation is. Okay, so the previously was 0.1 again, and now the core inflation is expected to be 0.3, same as the nominal. Okay. So the inflation rate year over year is at 2.7. So that was the month of a month. Now going to year over year is expected to be at 2.7% from previously 2.4. So 0.3% higher than previously. Okay. And the core inflation rate year over year is at 3%, expected at 3% from previously 2.8, so 0.2% higher than previously. All of those releases that we can see at the moment, so all of the forecasts, there's none expecting less than previous. Okay, so it's just showing to us that the inflation continues to be sticky. Even if it comes as expected, is more than the previous. Okay, so all the job that the central bank did was invalidated for the month of June. Okay, and I tell you more. Okay, let me just drink some water. Ooh, I think I'm gonna get a bit sick actually with this chain of waters, but that's okay. I think I have a good immune system. Let's go. Cool. So for the Fed, all of the job that the Fed has been trying to do in maintaining the rates higher enough to restrict the population to spend didn't work well. Okay, there's a few things I want to mention as well because lots of this inflation is getting picked up by the tariffs. And I've told that so many times not last month, in the last couple of months, that we would have a lot of inflation from these tariffs. And I even draw that for you guys. And the reason is pretty simple. Yes, it's good to have tariff, okay, into certain extent. The reason why is this. So first thing is, it's good to have tariffs for your own growth. So people will have to pay more to acquire your goods or services, in a sense. but mainly goods. Second, it's good because every time we have a bit more of a, as I say, a BOP on the beginning of the webinar, when I've mentioned about if I want to buy something from you, I have to buy from your own currency. So that's all good. That's good for tariffs. Okay. Now, the bad thing is after a few months, the tariffs start to resonate into their own population, into their own country. Okay. Because take that in a sense. If let's say USA, okay. Sorry. So if USA is there's a direct price increase, so the cost of push inflation. Okay, so that basically is if you have a if you have a company on USA and that company has to buy products from somewhere outside of USA, then what will happen is you have to buy with tariff. Okay. So because the country, because what USA did is imposing tariffs on imports. So let's say 25% on steel. Okay. The cost of those goods, they will rise immediately because the business rely on those imports. They will either absorb the cost and that will lower the margins of profit, or very, very rare they're going to do that, but more likely that they pass it on to the consumers in the form of higher prices. Okay. And this raises the consumer price index, the CPI, and that contributes to the inflation. So remember when I said about the PPI, that the PPI is the most important one, and then afterwards the CPI? It's because when the PPI gets, when the let's say you have a let's say you have let me just think about an example here. Um, let's say you have like a little shop, okay, and that shop, one of your raw materials that you have to buy is steel, okay. Now the steel price are 25% higher. So will you absorb this cost and be into a loss, or will you pass this on to your consumer so the consumer can pay the extra cost and you can maintain the same sort of, a little bit less, but same sort of profits? Most likely what you would do is pass it on the consumer, right? You want to absorb those costs. So that being said, that PPI is where it's going to measure this. Okay. What are the producers? Okay, the producers doing with the inflation? Are they pass it on to consumers? Are they retaining to themselves? Majority of them would pass it on to consumers. Okay. But all right, perfect. So if that, if you have the consumer, if the PPI the PPI would get to you and then you would have to pass it on to the CPI. So tariffs are not good, okay? But that's the thing. I'm not too certain about how long does it take to have the actual effect into the population. But what we've been looking at the moment, it's about 6 months, 6 to 8 months. Okay, so these CPI, the June CPI and the July CPI, will reflect very stickiness, and it's already expected. Okay, so just another real world example here that I've taught when I was drinking water was, if the tariffs on 300, let's say $360 billion in Chinese goods, they lead to a measurable increase into US price, washing machines, steel, etc. 2019, the Federal Reserve study, they estimated that the US consumers and firms bore almost the entire cost of tariffs, not Chinese exports. So the inflationary pressures increased in sectors directly affected by tariffs. Okay, so that's really, really bad. So just to finalize that, and I've talked about, I've done a whole webinar into January about this, but basically tariffs they serve as a short-term political or whatever strategic goal you want to call it. But from a macro standpoint, they are more inflationary than any other things because they raise the costs, they reduce competition, and they force the central banks like the Fed to difficult trade-off between inflation control and economic growth. Okay, so that is really bad in a sense. Okay, cool. That being said, what I'm expecting for the CPI today is a little bit of a more sticky than what the forecast is even saying. Maybe we're going to have a 0.4, 0.4 to 2.8. Okay, so that will definitely generate some sort of traction for the US dollar and for the gold. Okay, we're going to have a look on that soon. Now let's go for the next topic. So we've understand the sticky inflation and how the CPI remain elevated. Now, what's the CPI role into shaping the next Fed move? Okay, does anyone know how the CPI can affect the Fed? No? Most likely you guys know. Let's see. Inverse relationship. Inverse relationship. Interesting. What do you mean by inverse relationship, Stuart? Shaq say, doesn't it also discourage the consumer from purchasing certain goods? That's 110% correct. They could leave interest rates and change it. Yeah, that's one of the things. Yeah. So say by come out positive. Yes, coming out more sticky in a sense. Zod will say it's going to determine if they cut or not. Well, it's pretty good answers actually. I like the answers I've seen. That's pretty good. You guys have been following me for quite a while. That's awesome. Now, um, there's a few, yeah, not non-answers are wrong, okay? All of them are right. Alex say affects its decision on interest rates. Yeah. So that's good. You guys are correct. It's on the right way. It will definitely affect the decision of the Fed into if they're going to hike, cut, or pause. Okay. So the Federal Reserve operates into what we call a dual mandate. Okay, and it's basically two things. The first thing is the price stability, that's controlling inflation, and the second thing is they try to maximize sustainable employment. Basically, what they try to do is they reduce unemployment. Okay, so the Fed targets an inflation rate of around 2% based on the PCE. Okay, that's the Personal Consumption Expenditures Price Index. But CPI is the major reference, as I was talking with you guys. So how the CPI affects this is pretty simple. We can divide it into two dot points. Let's say the first one, if the CPI is rising. Okay, if the CPI is going up, um, not like that, not as I just show you guys, not like this, okay, because that's pretty low. But let me just bring a chart here from BLS, this one. Uh, this one. I think it's here. Yeah, there you go. That is on month 18, 19, 22. There you go. So from here, no. Sorry, let me just find out. Press that. Yeah, this one. There you go. That's the chart. So that's all items. That's the food at home, and food away from home. So what we want is the all items. Okay, we don't want food at home, and we don't want this one as well. So that's exactly what we want. When I mean inflation is rising rapidly, so CPI is rising rapidly, I mean this. Okay, not this. This is completely normal. Okay, inflation has to trend between 1% and 2%. Okay. As I say, the Fed has a target of 2% inflation. That's where they find the equilibrium point. Okay, cool. That's official data from US Bureau of Labor Statistics. Hopefully, make that clear. Cool. So, if the CPI is doing this, doing this, coming from 2% to 5 and then 7, 9, that's a problem. What the basically above the Fed target, what the Fed would do to control inflation is they're going to increase the interest rates. Okay. And they're going to do this basically aiming to reduce spending, difficult the borrowing, and investment. That will help to try to cool down the economy. Okay. Now, if the CPI falls significantly or turns negative, that's when we call the deflation, never happening. The Fed may start to cut the interest rates. Okay, that's exactly what we're doing at the moment. Well, at least we're trying to, in a sense. We're not cutting like others, but that's okay. Anyways, so that's basically it. Okay, so basically a high CPI reading suggests that the economy is overheating and the rates hike will likely happen. The lower falling inflation suggests cooling. And now is the point that I want you guys to pay a lot of attention. When we already having big jumps like that down, and we have small up moves as we having expected to have this one now, that's when we are having this sticky inflation. And that's when we only pay attention to one thing, and this is the CME. Okay? Why the CME? Because that's where most of our what we call the forward guidance will be present. Okay, so for the 30th of July, the CME Fed 2 basically shows us what are the expectations of the Fed to cut, don't do anything, or hike. Okay, so cut, pause, or hike. And these are the only three outcomes the Fed can do. They can either cut, they can either pause, or they can either hike. Now, the current target rate for the Fed is 425 to 450. And we have a 95.3% chance of doing nothing. As you can see, 429, 450. That's on 30th of July. If we go to 17th of September, we have 59.3% of chance of cutting 25 basis points. If we go for October, we have 46.9% of chance to not doing anything. And that was the tricky, because you always need to see, okay, so if they're going to cut in September, then the actual rate from there, the current rate will be this one. So 4 to 425. Going to October, that's going to be 4 to 425. It's going to be 47%. So it won't have any changes. Okay. And then December, they're expected to do another 25. So expectations are 50 basis points. If this inflation rate comes higher than expected, we may even have September, because as you guys can see at the moment, it's pretty close. Okay. Not that close, but we do have a bit of difference here. Okay. So let's say this 2.8% comes to jump into 59.3. So 59.3 plus 2.8 is 60. Well, let's say 62. Okay. So 62, and then the other one would be 38, let's say. Okay, 62, another one would be 38. So that is how we can see the CME Fed Watch tool. So 62% will be expected to cut and 38% will be expected to don't cut. If we have the inflation higher tonight, most likely it would be like sort of 50-50. Because if those guys, the inflation came in higher, these people have to jump to here. And those ones have to jump to here because they're expecting 50. So it's much more aggressive than 25. So they're not going to expect 50 base points when 50 base points when the inflation is going up. So what they're going to do is they're going to expect 25. So you're going to jump from here to here. So this will gain 2.8% and this will gain a bit from these guys. Okay. So that's how simple it is to look for the CME. Always pay attention into the current target rate and how it's shaping down at the bottom here. Cool. Now, if inflation comes higher, what we're going to have is lower pricing into cuts. And if the cuts don't happen soon as the market is expecting, what will happen is a lot of trade opportunities. Okay. So if for instance, we look at the next one, so October is expected no cuts, and then December is expecting 25, we may be only going to have 50 base points remaining for the last of the year. Okay, so we are in July at the moment. So we have a few coming in from September, October. So we have July, September, October, November, December. July, August, September, October, November, December. So the Fed only don't have 2 meetings, only don't have 2 months off without meetings this last 5 months of the year. 6 months of the year. Yeah, 5 months. So I think I've made that clear. Let's go to the last topic. So the last topic is trading the CPI, the strategies for a volatile release. Yes, my friends, it's going to be pretty volatile. These CPI release. I'm looking at the window. It looks like it's going to rain quite a lot. Very interesting. All right. So let's start with gold. Okay, let's start with gold. So gold has been quite a interesting trade so far for this year. And just like Bitcoin, actually, let me bring up something here. Take this down. Pretty familiar, Pretty familiar, right? Interesting. Very, very interesting. I'm not saying there is a correlation between those two, but I mean, look at this. Okay. Yeah. What can I say? Anyways, that's for Thursday. I'm going to talk about that on Thursday. So hopefully you guys back on Thursday. Now let's talk about gold here. So gold has been quite an interesting trade so far. And it has been consolidated into this area because there's no actual trigger. Okay, there's another word. There's no there wasn't a word that I used to use, but I just forgot it about. But anyway, so there's no trigger, there's no action to drive gold higher. Okay, gold wants to go to 3,500. Gold wants to go to 3,600, 800, or even 400. $4,000. Okay, so there's definitely a lot of people looking to long that, but it's just not yet the time. Okay, so what I think it can happen here with the CPI is if we have a higher CPI than expected, as you know, as we already looking at these, we already can see that CPI is expected to be higher than the previous. But if we get even higher than that, gold is trading on a range so far. Okay, we can see here that it's trading on a range, try to break to the down, sort of retested, and then continue to back to the range. So right now it's trading a little bit above the mid of the range. So most likely what we're gonna see is the gold coming at this high, okay, the top of the consolidation. The reason will be if the CPI comes up, then what will happen if the forward guidance of the Fed is they will cut less times, even less they already expecting, okay, because they were expecting 75, now they're expecting 50, and maybe if this inflation come much higher than expected, I'm talking about, pretty big release higher, then what we're going to get is what we're going to get is the CME Fed Watch tool priced in less cuts for October, less probability for October, and less probability for December. So therefore, we may only get a 25 base points cut. And what will happen is the population, the big mass money, will move the capital from assets that are not performing so well into safe haven assets like gold and US dollars. Okay, so therefore that's where we're gonna get the the gold up. So my trade for tonight is I'm planning to look for gold entries around. Let me just take this blue thing. Around somewhere at 3,350. So something around here. Oh no, wrong one. Okay, so something around here, because that is the last sort of, oh gosh, the sort of point of contact that we headed. Okay, the stop losses would be pretty short because it's just a sort of a day trading, and the take profit will be above these highs. I know it's not a 1 to 2 or nothing like that, 2 to 1 or nothing like that, but it's supposed to be a very quick trade. Okay, nothing to swing trade or anything like that. Just a quick trade on the release of the CPI. Okay, but of course spreads will be quite wide for the release in a few minutes after and a few minutes before, 2 minutes before and 2 minutes after. Most likely the spreads can widen quite a bit. So always manage properly your risk, because it's a speculation trade. It's nothing technical. There's no trend line, Fibonacci, nothing like that. We are purely trading into the news. Okay, now let's move on and go for euro dollar. So euro dollar, I'm expecting that. So this up move that I have drawn here is, yes, I still think that this is valid, but not for the trading of the CPI. Okay, let me take this blue thing off as well. So we are quite consolidated into this smaller range because we had this range consolidation. Then we've broke that price here, and we consolidated in a even a smaller range. Okay, so let's go for 50 minutes. Now we are a little bit below the 50% of this range. So this here. So we are a little bit below of this range. Most likely what it can happen is a bounce back below the lows. Okay, so anything that there you go. Anything that comes above these levels, I'm looking to short down to this area. Okay, looking to short down to this area. But I would wait for the CPI release. Most likely Europe will try to push euro above these areas. and then we could be looking to short that down to 1.16 500. If the CPI comes in much higher than expected, we can see 1.16 very, very soon. Okay, most likely that's what's going to happen. And will come down at the levels of 1.16 around this area here. Okay, most likely. All right. Now, Aussie dollar gets strong and weaker based into the US dollar. Okay, so that trade I've sent into the channel last week. But anyways, so the US dollar and the Aussie dollar has a negative correlation. Okay. Let me just, yeah, cool. This one. So as you can see, when the Aussie dollar is falling, US dollar is going up. When the Aussie dollar is going up, US dollar is falling. Okay, so they have a negative correlation, and it's like euro dollar, but a bit different. Not as, I wouldn't say as similar as that correlated, negative correlated, because euro dollar and US dollar index are literally just the opposite. But US dollar and Australian dollar, they are negative correlated, but not as euro dollar against US dollar. Okay. So what I'm expecting here is if the CPI comes higher, that are what we're looking for today, Australian dollar against US dollar can fall to this support area here. Okay. Maybe not in a row, maybe not now, like literally the CPI came out and boom. No, could happen, but I'm not expecting to happen like this. Most likely we'll probably just sort of, big bounce somewhere around these levels and then just slowly getting to 64,900. Okay, so for this, I'm looking to do my entry at around the break of this red, this blue, this green candle. Okay, this engulfing candle here. My stop losses would be just above. Okay, so the break of this candle, stop losses would be just above here, and my take profit would be at 64,900. There you go. So that's more of a bigger trade. Okay, so that's more of a 1 to 3. So you're risking around 16 pips to get back to you 52 pips. So that's pretty good, pretty decent. Okay, so let's say you're risking $10, you're gonna get back $30.03. If you're risking $100, you're gonna get back $300 around these levels. Okay, but again, that's more of a swing trade. Most likely the profit, the take profit won't get hit today. And how we're gonna manage that is, soon as the releases come out, most likely the order will be activated. If the order doesn't get activated due to the spread, the wider spread, then what we can do is wait for a break and then manually sell that. Okay, once the market reaches 50% or around 45%, close half of the positions, put the stop losses into break even, and just let it run to reach the take profit at 64,900. Okay. Now, the last one is the pound against the US dollar. There you go. So the pound against the US dollar, I don't really have anything, okay? And it's more of a, let me take this off. I thought about this potential target, to break this support, and then now it's just continue to go lower. The market is very, very extended in a sense. Can you enter there? Of course you can, but it's really up to you and your strategy. Okay, we do have a target at 1.33. We definitely do have a target here at 1.33. It's just going to depend on how the market will react to the CPI. If it goes above a little bit higher, I will be looking to short. If it continues to here until the CPI releases and just collapse down, I'm not looking to trade that, okay? Because the release is too close. It's like in 5 hours now, or 6 hours, something like that. But it's really, it's very on the top here, and the risk reward would be very bad. So I'm not looking to trade that. If you were to trade, what I would do is just zoom in here. I would wait for a bit of a pullback around this area. If that happens, okay, and then I would place my trade here with stop losses above here or here, like that. Show you. So somewhere around here, stop losses would be above either this high or this high. I prefer to do on this one, and my take profit would be down at 1.33. Okay, so that gives you a 1 to 3, exactly the same as Aussie dollar. Okay, exactly the same as Aussie dollar. Cool. All right, so just going through the topics again. What I think about the inflation is continue to be sticky, continue to have more inflationary pressures. We're most likely going to have more, most likely we're going to have a higher inflation than previously. Most likely maybe in line or a little bit higher than expected. CPI is definitely there's definitely a big role into shaping the next Fed move, and you've learned that and how to do that today with me on the CME Fed Watch, looking at paying attention at the current target rate, the actual the numbers down at the blue bar, and so on. And the tradings is gold long, euro dollar short, Aussie dollar short, and the pound dollar short. Okay, so basically heavily long on US dollar, short into other currencies, and long on commodities like gold. Guys, thank you so much. Hopefully you have all a great week ahead. It's just starting out, the week's Tuesday. I will be back tomorrow with FinLogic Sentiment Tool. Hopefully everyone have a great day, great afternoon, just depends where you're at. And yeah, that's about it. Thank you so much. Have a great one, and I'll see you back tomorrow. See you guys. Bye-bye.